The American economy is an economic train moving down a track that has no ending.
There will be a prolonged period of economic struggle, and the Fed is raising interest rates to curb inflationary pressures. Many aren't happy with this news, and you might be too. Despite the Fed's efforts, we are still a long way from addressing inflation, and here's why. But before we get into it, do give us a like and subscribe to the channel for more content like this. If you're done with that, then let's get started. Federal Reserve officials are now forecasting only one interest rate cut for 2024, reinforcing their commitment to combating inflation by maintaining higher borrowing costs. This is a significant decrease from expectations in March, which anticipated 3 rate cuts for the remainder of 2024. This shift comes after repeated statements from Fed officials indicating that interest rates are likely to stay elevated for a longer period due to rising price pressures in the first quarter. Among these officials is Patrick Harker, president of the Federal Reserve Bank of Philadelphia, who asserts that a single rate cut in 2024 is appropriate given the current inflation outlook. New inflation data reveals that we are still far from fully addressing inflation, as the latest CPI reading of 3.3% marks the 38th consecutive month with inflation above 3%, despite being below expectations. Additionally, the Fed has increased its underlying inflation forecast for 2024 to 2.8%, up from March's 2.6% forecast. Harker has emphasized the need for more economic data to confidently determine that inflation is on track to meet the central bank's 2% goal, indicating that it will take a long time to return to acceptable inflation levels. The Fed has also revised its estimate for where interest rates will settle in the long term, suggesting that many officials do not expect borrowing costs to return to pre-pandemic levels. Maintaining higher interest rates for an extended period appears necessary to tackle persistent inflation, but it presents significant challenges for other sectors of the economy. The banking industry, for instance, is experiencing substantial unrealized losses from devalued loans and faces the potential for a second wave of bank collapses before rates are cut. The real estate sector is also suffering from low affordability and record low mortgage applications due to high mortgage rates, with the average homebuyer now spending a larger portion of their income on housing costs than at any point since the 1980s. This has made housing even more expensive than during the peak of the global financial crisis. Consumers with auto loans, student loans, or credit card debt are also feeling the strain of record-high interest rates, pushing many households to their financial limits. Prolonged high rates are detrimental to the labor market, as indicated by warning signs in the latest jobs report. While the U.S. added 272,000 more jobs in the previous month, surpassing economists' expectations, most of these jobs came from 3 main categories: health and education, leisure and hospitality, and government. Notably, 617,000 new government jobs were created in the last year, accounting for 22.4% of all new jobs. This raises concerns about the true state of the jobs market without substantial government job creation. The latest jobs report also shows an unexpected rise in the unemployment rate to 4%, ending a 27-month streak of being below 4%, the longest since the 1960s. Additionally, the household survey revealed a decline of 48,000 in the number of employed people. Anecdotal reports from job seekers indicate that finding employment is currently challenging, with the Indeed Job Posting Index showing a consistent decline since its peak in January 2022. Significant sectors like finance and tech have been particularly hard hit, with job postings in these areas falling below pre-pandemic levels. Historically, the unemployment rate follows interest rate trends with a lag of a few years, suggesting that the recent rise in unemployment is likely the beginning of a more sustained increase. This correlation implies that rising unemployment, typically observed during recessionary periods, is imminent. Despite the Fed's projection of maintaining higher rates for longer, they also predict a sharp decline in interest rates in 2025, with the number of rate cuts forecasted for 2025 increasing from 3 to 4. This signals that rising unemployment and a potential recession over the next 12 months could prompt the Fed to cut rates. Moreover, The U.S. deficit has grown by 5% from a year ago due to high borrowing costs, bringing the year-to-date deficit to $1.2 trillion. With the government's annual interest payments on debt now exceeding $1 trillion, there is a growing pressure to reduce interest rates. The Fed faces a dilemma. Keeping rates high inflicts economic pain, while cutting rates too quickly risks a resurgence of inflation, potentially leading to stagflation. The banking sector is particularly vulnerable, with the combination of high rates and commercial real estate risks threatening bank stability. This precarious situation underscores the Fed's challenge in balancing inflation control with economic stability, making their upcoming decisions on interest rates critical. The Federal Reserve's cautious stance shows the complexity of the inflation issue and the delicate balancing act needed in monetary policy. Although the objective is price stability, achieving it involves numerous challenges. Forecasting just one interest rate cut for 2024 suggests that fully addressing inflation remains a distant goal. Tackling inflation demands a comprehensive strategy beyond monetary policy. Structural problems like supply chain disruptions, labor market imbalances, and geopolitical uncertainties must be resolved to foster a more stable economic environment. Additionally, fiscal policies that encourage sustainable growth and investments in infrastructure, education, and technology are vital for long-term economic resilience. The Federal Reserve's projection of a single interest rate cut for 2024 highlights the ongoing struggle to control inflation and maintain economic stability. While higher borrowing costs are a necessary tool to combat inflation, they also pose significant risks to economic growth and financial stability. The road to fully tackling inflation is long and requires a coordinated effort across monetary, fiscal, and structural policies. As we navigate this challenging landscape, it is essential to remain vigilant and adaptable, ensuring that policy measures are effective and responsive to evolving economic conditions. So, what are your thoughts on the Fed's move? Do you think it'll alleviate the current crisis, or will it only make things harder for us? Let us know in the comments section below. If you like today's content, do give us a like and subscribe to the channel. Thank you so much for watching, and we'll see you on the next one.